Tokyo, 1989. A single square meter of land in the Ginza district costs more than an entire acre in Manhattan. The Imperial Palace grounds are worth more than all the real estate in California combined. Japanese companies are buying Rockefeller Center, Columbia Pictures, Pebble Beach Golf Course. American bestsellers warn that Japan will own the 21st century. 35 years later, Japan's stock market still hasn't recovered to those 1989 levels. An entire generation has lived their entire working lives in economic stagnation. The country that was supposed to dominate the world became the cautionary tale everyone studies to avoid making the same mistakes. This is the story of how the most spectacular boom in modern economic history turned into the longest stagnation any developed nation has ever seen. Let's start in the 1980s, because you need to understand just how insane things got. Japan in the 1980s wasn't just growing. It was rewriting the rules of what economic growth could look like. Between 1955 and 1989, Japan's economy grew at an average of 10% per year. A country destroyed by war became the second largest economy on Earth in just 4 decades. Sony, Toyota, Honda, Nintendo. Japanese products weren't just competitive, they were superior. Better cars, better electronics, better manufacturing processes. The world watched in awe and in fear. American business schools taught Japanese management techniques. Politicians warned about falling behind. Books like Japan is #1 became bestsellers. The conventional wisdom was clear. Japan had figured out something the West hadn't. A better form of capitalism, cooperation between government and industry, long-term thinking instead of quarterly profits, lifetime employment creating loyal, productive workers. And the numbers seem to prove it. By 1989, 8 of the 10 largest banks in the world were Japanese. The Tokyo Stock Exchange had a larger market capitalization than New York. Japanese companies had cash reserves that made American corporations look broke. But underneath this success, something bizarre was happening. Something that would later seem obvious, but at the time looked like genius. Real estate prices were doubling every 2 years. Not in desirable neighborhoods, everywhere. A small apartment in Tokyo cost what a mansion in Beverly Hills would. Office buildings traded hands at prices that made no mathematical sense based on rental income. One executive calculated that you could sell the Imperial Palace grounds, buy all of Canada, and still have money left over. The banks loved it. They loaned against real estate. Real estate went up. They loaned more. It went up. More. Perfect system. The stock market did the same thing. The Nikkei 225 index went from 10,000 in 1985 to 38,915 by December 1989. Companies with mediocre products had valuations that suggested they would dominate the world. It didn't matter. Stocks only went up. Japanese investors started buying trophy assets around the world. Not because they made business sense, because they could. Because Japanese banks would loan them the money at low rates using Tokyo real estate as collateral. And because owning Rockefeller Center or famous golf courses or Hollywood studios proved Japan had arrived. Some people noticed the insanity. A few economists warned that prices had disconnected from reality, that a square meter of land couldn't actually be worth more than a square meter of land anywhere else just because it happened to be in Tokyo, that stock prices based on the assumption of infinite growth would eventually hit reality. The government noticed too. By 1989, officials at the Bank of Japan and the Ministry of Finance realized they had a problem. Not a crisis yet, but clearly a bubble that would have to deflate somehow. They decided to engineer a soft landing. On December 29, 1989, the Nikkei hit its all-time high of 38,915. That was the peak, the absolute top. What came next wasn't a soft landing. It was a slow-motion crash that would last 3 years and take the market down 60%. Real estate followed the same path. Prices started falling in 1991. They kept falling for 15 years. By 2005, commercial property in Tokyo had lost 87% of its value. Residential real estate across Japan fell to levels not seen since the early 1980s. All those loans the banks had made using real estate as collateral were suddenly backed by assets worth a fraction of the loan amount. The banks were destroyed. Not quickly, like in a normal financial crisis, slowly. Year after year of bad loans accumulating. Companies that should have gone bankrupt were kept alive because letting them fail would expose how bad the bank's books really were. These zombie companies couldn't invest, couldn't grow, couldn't hire. They just existed, consuming credit that could have gone to productive businesses. Japan's government tried everything. They cut interest rates to basically zero. They spent massive amounts on public works projects, bridges to nowhere, highways through mountains, airports in rural areas that barely got used. The national debt exploded from 50% of GDP to over 200%. Nothing worked. Growth stayed near zero, sometimes slightly positive, sometimes slightly negative, but essentially flat. The problem wasn't lack of stimulus. The problem was deeper, structural, psychological. Think about what happens in an economy when everyone knows prices won't go up anymore, when everyone has watched their biggest asset lose half its value over a decade, when everyone sees their neighbors' businesses barely surviving on bank loans that should have been written off years ago. You stop spending. You save more. Not because saving makes sense when interest rates are zero, because you're scared, because you remember what happened, because every institution you trusted to manage the economy turned out to be wrong. Businesses stop investing. Why build a new factory when demand keeps falling? Why hire more workers when your existing workforce is underutilized? Why take risks when playing it safe is the only way to survive? Young people stop having children. Why raise a family when your salary hasn't increased in 10 years? When your parents lost their retirement savings in the crash? When lifetime employment disappeared and even big companies started laying people off? This is deflation. Not just falling prices. A deflationary mindset. A collective decision that the future will be worse than the present. So the rational thing to do is nothing. Save what you have. Don't take chances. Wait for things to get better. Except, things don't get better when everyone is waiting. Japan's population started shrinking in 2008. Not because of war or disease. Because people in their 20s and 30s looked at the economy and decided having kids was too risky. The fertility rate fell to 1.3 children per woman. You need 2.1 just to maintain population. Japan started losing 500,000 people per year. Small towns became ghost towns. Schools closed. Businesses couldn't find workers. The government tried everything. Tax breaks for families. Subsidies for childcare. Immigration remained limited because of cultural resistance, so the workforce kept shrinking. Each working person had to support more retirees. The burden kept growing, and the deflation continued. Prices fell, slowly but steadily. Wages stayed flat. Companies hoarded cash instead of investing. Banks kept zombie companies alive instead of lending to new businesses. The whole system was stuck. Economists gave it a name: the lost decade. Then, when that decade turned into 2 decades, they called it the lost decades. By 2024, it had been 35 years since the peak, and Japan's economy was barely larger than it had been in 1995. Let me put that in perspective. In 1995, Japan's economy was about the same size as Germany's. Today, Germany's economy is 40% larger. China's economy was 1/5 of the size of Japan's in 1995. Today, it's 4 times larger. South Korea was poor enough that Koreans went to Japan to find work. Today, their per capita income is nearly the same. Japan didn't collapse. It didn't have a revolution or a depression. It just stopped growing for an entire generation. The mechanism was simple once you saw it. High debt means consumers can't spend. Aging population means fewer workers and less demand. Zombie companies mean capital is trapped in unproductive businesses. Low growth means low inflation, which means holding cash is better than investing, which means even lower growth. It's a loop. Each element reinforces the others. Breaking out requires someone to go first. Businesses to invest even when demand is weak. Consumers to spend even when the future looks uncertain. Banks to take risks even when safe loans are available. The government to force change even when powerful interests benefit from the status quo. Nobody went first. Everyone waited for someone else to fix it. The irony is that Japan's 1980s boom created the conditions for its 1990s bust. The lifetime employment system that made workers loyal also made companies unable to adapt when times got tough. The close relationship between government and industry that coordinated rapid growth also prevented creative destruction when old companies needed to die. The risk-averse culture that produced quality products also made people too scared to take chances when the economy needed bold action. The same strengths became weaknesses, the same features that drove the boom locked in the stagnation. Other countries watched and learned, or at least they thought they learned. When the US housing bubble burst in 2008, policymakers said they wouldn't make Japan's mistakes. They would act faster, cut rates quicker, inject more stimulus, force banks to recognize bad loans immediately. They did all of that. And it worked better than Japan's approach, but it didn't prevent a long period of slow growth and low inflation. It didn't stop young people from having fewer children. It didn't eliminate the psychological scars of watching asset prices collapse. Because the lesson from Japan isn't really about specific policies. It's about what happens when an economy gets so over-leveraged, so dependent on rising prices, so convinced that boom times are permanent, that the bust becomes inevitable. Japan's mistake wasn't that the bubble popped. Bubbles always pop. The mistake was inflating it in the first place, letting land prices become detached from economic reality, letting banks make loans based on fantasy valuations, letting everyone believe that Japan had discovered a new kind of economics, where prices only went up. The pop was painful. The stagnation was worse. 3 decades of living in the shadow of a boom that should never have happened. 3 decades of young people entering a workforce with no growth, no opportunity, no dynamism. 3 decades of companies playing it safe, of banks protecting zombie firms, of politicians afraid to force change. This is what economic stagnation actually looks like. Not a dramatic crash that gets fixed in a few years. A slow erosion of potential. A generation that grows up knowing things used to be better and probably won't get better again in their lifetime. A society that loses its dynamism 1 year at a time. Japan's economy today isn't terrible. People aren't starving. The unemployment rate is low. Infrastructure is excellent. It's a comfortable, safe, orderly stagnation, which is why it's so insidious. There's no crisis that forces change, just a slow acceptance that this is how things are now. The Japanese have a word for it. Shogunai. It can't be helped. A resignation to circumstances beyond your control. That mindset explains a lot about why the lost decades lasted so long. The question Japan faced in 1989 wasn't really about monetary policy or banking regulation. It was about whether an economy can sustain itself on ever-rising asset prices, or whether every boom contains the seeds of its own bust. History gave Japan the answer, and then made them live with the consequences for a generation. The real lesson is this: when everyone believes prices can only go up, when everyone borrows based on that assumption, when everyone's wealth depends on the boom continuing, the correction isn't just an economic adjustment. It's a psychological shift that changes how an entire society thinks about the future. And once that shift happens, it's very, very hard to shift back.